Look at the scale of the modern U.S. federal budget. It consumes over $4 trillion every single year. And if you trace where that massive stream of revenue comes from, you'll find it's overwhelmingly pulled from earned income, extracted straight out of the paychecks of American workers. Yet for the first 124 years of its existence, the United States operated without a permanent income tax. There were no payroll deductions quietly siphoning off wages, no April 15th deadline, and no IRS. This was due to a constitutional safeguard called apportionment. The rule dictated that if the federal government wanted to levy a direct tax, the total dollar amount had to be divided among the states strictly by their population, regardless of how much wealth those citizens actually held. This made direct taxation a political impossibility. A poor farmer in a low-population state would end up paying a much higher effective tax rate than a wealthy merchant in a hub like New York, simply because of the math. The founders engineered this legal firewall to keep the central government from reaching directly into the pockets of its citizens. Instead of taxing labor, the early government funded itself primarily through the tariff, a tax on foreign imports, and the sale of vast tracts of public land. This border-based tax was efficient. Without a massive bureaucracy, tariffs generated enough revenue to pay for the military, service the national debt, and keep the early federal government running. This chart illustrates the tariff system's core economic limitation, the Laffer curve. As the government increases the tariff rate on the x-axis, total revenue rises, but only to a point. If pushed too high, foreign imports stop, the tax base shrinks, and federal revenue plummets. This mathematical trap meant federal spending was naturally capped at a tiny percentage of GDP. The budget was restricted to bare essentials like defense and customs enforcement. The tariff system acted as an invisible structural ceiling, preventing the creation of a large administrative state, regardless of political ambition. But late 19th century industrial growth turned this system into a burden for working families. High tariffs meant that ordinary people paid more for basic goods. While it inflated the cost of living for farmers and workers, the tariff legally protected northern industrial monopolies from foreign competition. This allowed a small class of industrial tycoons to accumulate staggering wealth, effectively using the government's revenue system to pad their own margins. This inequality turned the government's funding mechanism into a reverse wealth transfer, sparking a populist crusade to tax the rich directly. When Congress tried passing a peacetime income tax in 1894, the Supreme Court struck it down by invoking the founders' original apportionment rule. In response, the progressive movement launched a relentless public campaign to permanently bypass the court through a constitutional amendment. In 1913, the 16th Amendment was ratified. It gave Congress the power to tax income from any source, without regard to state populations. This didn't just target Gilded Age tycoons. It dismantled the constitutional firewall entirely, removing the mathematical limit on federal revenue forever. The income tax started small, but it rapidly expanded to meet the financial demands of the world wars. During these emergencies, the tax base expanded from the top 3% of earners to the vast majority of working Americans. In 1943, the government introduced withholding, requiring employers to intercept tax money before the worker ever received their paycheck. By taking a continuous cut directly out of payroll, the government diffused the financial blow. The cost of the tax became a silent subtraction, hidden inside the machinery of everyday commerce. This extraction of wealth became a permanent, almost invisible part of American life. The state's underlying philosophy shifted. Before 1913, the government existed at a distance, funded by foreign commerce at the ports. Today, it is sustained directly by the daily labor of its people. With the revenue ceiling removed, the federal government could afford limitless ambition. It expanded into social safety nets, vast bureaucracies, and a permanent global military. In a historical irony, the industrial tycoons who profited from the old tariff system fueled the public outrage that ultimately ended the era of small government. The power and reach of a government are not just determined by its ideals, but by the mathematical limits of how it collects its money.